Could U.S. trade policy soon make American chipmakers pay the federal government to sell chips to China? Could a revenue-sharing deal between the U.S. and giants like Nvidia and AMD rewrite global tech supply chains overnight? And if this is true, who wins and who loses? Investors, data centers, cloud customers, or geopolitical power plays? No matter where you are in the world, if you want fast, clear market updates on AI chips and macro policy, subscribe now. We release deep market briefings every week. Let's jump in. Over the last 72 hours, trade headlines exploded. Reports say Nvidia and AMD agreed, tentatively, to remit 15% of revenue tied to AI chip sales into China as part of a new monetized export process tied to U.S. tariffs and licensing. At the same time, a looming deadline, a tariff pause that could end on August 12th, has markets nervy. If these reports hold, we may be witnessing a new, unprecedented blend of industrial policy, export controls, and corporate compromise. Let's unpack the idea. Traditionally, export controls deny or allow sale of sensitive electronics. This alleged arrangement would be different. It's not just permission or denial. It would make licensing conditional on a fee or revenue share paid to the U.S. government, effectively turning export licensing into a source of state revenue. For companies, that means a new cost line on every sale into China. For governments, it's a lever to both control advanced tech diffusion and capture economic value. Why might companies accept this? If the Chinese market represents tens of billions of dollars of revenue, a 15% fee could still leave profitable margins, but only if licensing certainty, supply chains, and demand remain intact. For the U.S. government, it'd be a way to retain leverage while allowing some commercial flows to continue. The geopolitical math is immediate. China needs AI compute to train large models and run inference at scale. Deny the chips entirely, and Beijing will double down on homegrown alternatives, black markets, or third-party routing. Allow the chips, but tax the flows. And the United States gains influence and revenue, but risks accelerating Chinese investment to remove dependency. Allies in Asia and Europe will watch closely. Will they align with revenue share licensing? Or will they balk at the precedent of monetizing export controls? Meanwhile, foundries, OSATs, and HBM makers in Taiwan, Korea, and Japan must navigate new risks. Will customers renegotiate contracts? Will carriers and cloud providers face price shock? Markets hate uncertainty. In the short term, we should expect volatility across Nvidia and AMD shares, chip suppliers like HBM makers, memory, power ICs, and cloud names that depend on GPU capacity. If earnings forecasts don't incorporate a 15% revenue hit for China sales, analysts will reprice models fast. Medium term, revenue share could reduce gross margins for China sales or push OEMs to raise customer pricing in China, if permissible, compressing demand elasticity. Alternatively, it could accelerate Chinese replacement programs, so invest more in domestic GPUs, NPUs, and data center buildouts. Is this legally straightforward? No. Company boards and counsel will want clarity. A government-mandated revenue share raises questions about antitrust, compensation, shareholder disclosure, and fiduciary duty. Firms must explain why a deal that reduces long-term shareholder value, at least in theory, is preferable to losing the China market completely. Executives may argue the arrangement reduces regulatory uncertainty, and that predictable greater than 0% revenue is better than unpredictable 0%. Technically, the chips at issue, high-end AI accelerators, are central to training large language models. If supply becomes conditional on revenue takebacks, hyperscalers and AI startups may respond by stockpiling, re-architecting to use alternative accelerators, or paying premiums to secure capacity. So, you can expect a scramble in procurement and possibly long lead times for capacity expansion. All right, let's break down 3 possible scenarios for what happens next. Scenario A. The deal gets formalized, licensing stays stable. Markets, after an initial shock, start to stabilize. Nvidia and AMD see their revenue grow, but at a slower, more predictable pace. China keeps investing, but, dependency on foreign tech sticks around for several years. The main winners here? The U.S. fiscal coffers and, a handful of domestic suppliers. Now, scenario B, the deal collapses or there's just no consensus. Exports freeze up, the black market gets bigger, and China really speeds up its push for domestic substitutes. In the long run, Chinese chipmakers come out on top, while Western hyperscalers and corporate customers who need immediate capacity, well, they lose out. Finally, Scenario C, a kind of hybrid outcome. Licenses are granted selectively, companies start tying pricing to different consumer segments, and geopolitical bargaining just keeps going. So expect some pretty episodic volatility, and honestly, long, drawn-out supply negotiations. If you're trading Nvidia or AMD, you'll want to keep a close eye on licensing announcements and earnings guidance. If the quarterly numbers don't show a haircut for China revenue, the risk is really in that first market reaction. You might want to hedge with options around those earnings windows. Now, if you're running a cloud or AI startup, it's a good idea to lock in capacity wherever you can, diversify your suppliers, and stress test your models for scenarios where Nvidia isn't your main path. And for those thinking longer term, this policy could slow short-term growth, but actually speed up long-term competition. Maybe consider a barbell approach, keep core positions in established leaders, but also take selective bets on emerging GPU and AI hardware alternatives. So this isn't just a trade story. We're looking at a whole new chapter where geopolitics, corporate strategy, and markets all intersect right in the open. If the 15% revenue model becomes policy, we're basically in a world where governments are negotiating commercial fees just for the privilege of export. That totally shifts incentives for everyone in the AI stack. And it really brings up a big question for both investors and citizens. Do we want markets to be steered by political bargaining or by competition? So what do you think? Is this deal actually going to stick? Drop your view in the comments below. And if you found this briefing helpful, don't forget to like, share, and subscribe. We'll be covering updates live as they happen.